and welcome to today's session. And as you can see from the title, it's something really different, but hopefully applicable to everyone. Over these couple of weeks, the last few weeks, I've had to chat with people who are around this, and I decided let me create a session that will just be around this because it seems that I have a method that I use in evaluating investments, and most of the things people did, put their money in that kind of burn and crash are things that my method flagged for me as not good, and I never bothered to even consider them. I didn't even try to do any analysis beyond. Once the thing showed red light, I knew that this is not what I want to put my money into. So I want to explain to people how to do this, and not doing this as a voodoo or as something that someone is telling you as a rule, but understanding the concept, understanding the principles behind it. And there's a kind of mathematical calculation too behind it. So it's not going to be something like you feel like this today and tomorrow you feel differently. If it is 2 kg, it is 2 kg. 2 kg doesn't change today from yesterday. But if I say if it is too large, large can be relative, right? So I'm going to be very, very specific to numbers. So that way you will know without having to consult someone else if the comparison I'm asking us to do, pans out correct or not. All right, so without taking too much time, just help me confirm again if my face is visible, my audio is still good. I have a fan blowing me, but if it's making background noise, I can turn it away. And lastly, also, if you see my screen clearly, can someone help me with a confirmation on that? Seems it's really quiet. Or even if it's by chat. Okay, I'm hoping somebody will confirm for me as they did before. So anyway, in hope that all is still good, I'm going to just go ahead. Okay, let me see. Oh, all right. So I now even see myself. I think my screen was not showing clearly before. All right. So thank you very much for the confirmation. Merci beaucoup. And so about us, we are a training company, and in case you need training on financial modeling, Excel, Power BI. If you are interested in any of our classes, you can go on our website, and we always have classes running. These are the ones running this week, so I'm going to quickly be fast with that. Then one of our sponsors, we are sponsored apart from we powering it, UrBizEdge. There is also FMI Institute.com, Financial Modeling Institute. They also power us. They are one of our sponsors. If you are interested in doing the upcoming May exam, then they've given us a 15% discount code specially for the community, for the house, so you can take advantage of it. I will probably put this in the chat box so that anybody who wants to use it can take advantage. All right, so let's go straight to the main thing, right? How do I evaluate, every investment that opportunity that I come across? In fact, let me not personalize it. How should you? Because this is something that came from most of my textbook readings. It's not a stuff that I came up randomly by myself. It is something that if you do corporate finance a lot, if you've done academic courses, even those who do MBA, just that, when people do MBA, most times they are not doing it with their mind to the finance side. Most people just see the finance side as something that's weighing them down. They don't put their minds to it. And generally, I think when people are learning things from the academia space, they kind of always never think of applying it in the real world. Maybe that's why I find that originally having an engineering background has helped me a lot. Why? Because what we were taught in school and when I went for my internship and my first job, I was applying them. So when I break a rule that we were taught in the books, I see the result. The result is that something is not going to work, and that's if I'm lucky. And worst can be that you damage an equipment, you go set a frequency different from what it should be. You can blow the antenna, and those antennas are really expensive. So because we were taught to value what we read in the book as very practically relevant, right? When I switched to finance, I went with that mindset. Everything I was learning, after I understand the principle, I will go and read about how to apply it in the real world, because for me, I felt these things, if they are telling us they are this important, right, then it means that in the real world, they should be doing something really great, and that's why I ended up also doing masters in financial engineering, because I was always been fascinated by people who design investment products, people who design things that well, maybe you don't buy, but I sometimes buy into them. So there are some products that are ETFs, there are some products that are like synthetic investment opportunities. Let me use that word, securities. Some people who design how to invest in commodities, how you buy calls, how you price calls, and things like that. They've always fascinated me because that is the height of application of your finance knowledge in real world things, in what people put their money in. So those stories aside, what I'm just trying to bring to our knowledge is the fact that this is the real way to think about every investment opportunity you are trying to put your money in. The number one thing is that there's what we call the risk-free rate. Risk-free rate is if I have 1,000 USD, right? And I'm looking for a way to invest it in. I could go and buy US federal government bonds. I could buy US Treasury bills, right? And I know that if I buy US Treasury bills, I am guaranteed to get a return. I'm guaranteed whatever it is that they have promised. Why? US government prints out those dollar bills. So there's no way that they are going to not be able to print out the money that they will pay me. Imagine you are the manufacturer of Coca-Cola, and then you are promising somebody that, oh, I will give you 4 bottles of Coke next month. The person should not have any worry. Why? Because you are the manufacturer. You produce it. So it's very rare that something you produce you won't be able to give as promised to someone as when you did the promising. So yeah, you can say technically it can happen, but practically so far in the finance world, it's not yet happened. It's a very, very rare thing. Okay. So now the risk-free rate is the first thing. If you see it's is at the bottom. Anything you are investing in, you first want to consider for that currency of that investment, what is the risk-free rate for that same currency? What do I mean? If I'm investing in an opportunity that it's in Naira, then I'm going to think about what is the risk-free rate of me buying Nigerian government treasury bonds, Nigerian government bonds, so we call our own FGN bonds, right? So if I buy that and government is giving me 12%, then that means 12% is my risk-free rate. Now, understand that I didn't talk about bank fixed deposit. I didn't talk about bank interest rates. Too many people use that as the benchmark in considering. They were like, no, I can never put my money in, or this thing must be a scam. If banks are paying 2%, then how can you say you are going to pay 8%? Banks are a class of their own. They are not, technically speaking, they are not catering to the investment savvy people. So bank is not who you consider the rate, the fixed deposit rate, whatever you get from a bank is outside of what you're going to consider in when you are trying to decide whether an investment is reasonable or not. So what you consider is the government that owns that currency, what do they give on their bonds? Okay, that's the risk-free rate. Now the rule is this: any investment that promises you 3 times or more the risk-free rate, don't analyze it. Don't even bother trying to justify where's the money going to come from. I want to do due diligence. It's just like somebody saying, I'm going to cross this expressway and no car is going to hit me, and you want to be analyzing how he's going to cross that way with no car hitting him, and it's a busy highway. It doesn't make sense. The best thing to do is to just say, well, I'm not going to involve myself in that kind of a risk. It's a risk that does not what that is not worth the stress. Okay, so any investment opportunity that is giving you 3 times, that is promising you that I'm going to guarantee you 3 times more than the risk-free rate, you run away from it. So let's think about in Nigeria. So if someone is saying, oh, you know what, we have this investment opportunity where we have a bunch of houses, real estate properties, we are leasing them, we're doing short let, we're doing, and they describe it, it makes sense. And they're saying, you know, you have a guaranteed, the key thing is if they say that they're telling you it's a guaranteed return of 40% a year. 40% right now, you can approximate Nigeria's Naira risk-free rate at 10%. 40% is already 4 times 10%. You run away. You ignore it. You don't go for that opportunity. Why? I will explain later, you know. But just know it that any investment that promises you 3 times or more the risk-free rate and says it is guaranteed. Guaranteed means that, you know, we are going to definitely pay you. Then you run away from it. It is something that will eventually crash. You know, it's not that maybe it will crash instantly, except if for you, you think, oh, it's not going to crash in the next 2 years and you want to cash out before it crashes, then you know you are doing something different. You know, that's what you're doing. But for you to think, oh, no, I've tested, I've analyzed their books, I've talked about it, it makes sense, they're going to keep getting it. You know, you have just sold yourself into the hands of a high risk, something that's going to crash and burn, and it's like a trap because you start small, keep putting your money in, and they'll keep paying you. You know, they always say that they've never defaulted, which is true because no investment will default more than once. If you default once, nobody's going to put their money there again. So you're not looking for someone that has never defaulted more than once, or like I've never defaulted is never a reason. It's never anything to consider when you're investing, because defaulting is like somebody saying, you want to hire someone and he says, and his health is not good, you know, you are looking at his health report, you've done medicals, and all the medicals are saying he's in a really bad shape, and you want to hire him as someone who is going to be a field officer, and the person is saying, I've not died before, you know, why will I now go and die on the field? You know, that's even what you want to avoid, right? You know, you don't want him to die on your job. So the same thing, if they're telling you, oh, we've not defaulted before, it doesn't make sense, because doesn't make any sense. If not defaulted before is not something to give me confidence, because you can't default more than once. If you default, you are out of business or automatically, right? So that's never any excuse. A Ponzi scam will accept MMM that keeps trying to come back again, but all of them, they only default once. It's just once for them to die, right? And when they die, it's all your money that is gone. You know, it's not like that you get all your money back and think of how to now do what to do with it next. So what I've just explained right now is, more importantly, I'm going to again explain how this 3 times is a big deal, right? But just take it as a rule for now. Then later, when we do the mathematical aspect of what you're seeing, then you will probably understand, you know, why it is not possible for anything to give you more than 3 times the risk-free rate, and call it a guarantee, and it will be sustainable for a long time. It will just crash. It doesn't matter if what they are doing is legit. It will crash. That's just the way it is. So now I'm going to move on to, so you've considered number 1, you know, the risk-free rate, and what you are considering for investing in is not promising this red flag 3 times or more. Then what is the next thing? The next thing is you come over here. So let's start with this part. Comparable returns, right? Everything you are going to do, there's nothing that is really new under the sun, right? There's nothing anybody is doing that is so unique that it has not been done before, cannot be compared to something else. So the key thing is you want to look at what they're investing in and compare and check out what is the comparable return. What do I mean? Again, I'm going to go out of this slide very soon and explain practically, but right now, what we are talking about comparable is, think about the sector. If someone is telling you that we are doing a special thing in the agri sector, then sector is agri. There's something about that sector that is uniform to every player in that sector. If the person says we are into mining, we are mining gold, we are mining whatever it is that they are mining, that is a sector. There's a sector called mining, and there is a normal kind of returns in that sector, right? If someone says, oh, what we are doing is we are doing shortlets, we are buying houses and flipping them really fast, but we're doing it in a way nobody else is doing. Awesome. But what they are still doing is within the real estate, and there's something that is normal within the real estate. Okay. So you want to check that sector. What is the comparable return? For instance, if someone says, oh, what we are doing is we are lending money, we are into microfinance, right? So the money you give us, we're going to lend out to other people. And then, because we are learning at a very, maybe they didn't even tell you, we're learning at a very high rate of return, for people that need to use the money quickly for something. And, so we are able to give you X percentage of annual returns, right? The key thing you want to take is whatever they are saying, you put it aside and say, what is the comparable return? I know that in the microfinance sector in Nigeria right now, right, on average, it is 3% per month. Yes, some people charge 5%, some people, but for you, what is comfortable to take? That's why I'm saying the industry average is to take 3% per month. That's the interest rate most of them on average charge when you take everybody, and you bundle them and you find the average. This is what the average comes. The range is actually 1.25 being GTB that does 1.25 to as high as 5%, right? But most of the big players circle around 3%. So if you take 3%, 3% is 36% per year, right? This is their entire basis of their gross earning. Now, it's out of it, they're going to remove their general and admin expenses. They're going to remove the expense of operations, so I'm going to call it SG and A, right? So there's no way they can pay you all of this because they have expenses also to cover, right? So most likely they will pay you, what can be healthy to pay you might be like 24%, right? So if you look at it, if they promise 24%, right, it's still, kinds of tallies with what you can say is comparable in that industry. Because like I've explained right now, there is a range and there is what most people do in that industry. And then there is also what they are going to need to spend to cover their own salaries and admin operations. So you don't want one that says, oh, I'm going to give you 40% return. 40% is so far away from that 24% that I'm saying is the industry comparable that you want to run away. You don't want to put your money in it. Anything that is going to be so far above the comparable return is a huge red flag. Okay. Then I'm going to come also to how this splits into ROI, how you get your returns on investment and capital. But let's go level by level. So the key thing is that you want to always have what can be compared. What is the industry comparable? If you don't have it, then please don't go ahead. That's why I don't invest in things that I don't thoroughly understand. Thoroughly understand doesn't really mean that I know it out, know how to run it from end to end, but that I know what that industry is like and what is comparable. That at least I must know. So if I'm going to put my money into an agri business, right, I will want to know. So if you're going to be doing cassava, right, then I will want to know what people who do cassava, what kind of return they make. So if they make, say, 60% annual returns on their cassava harvest and sales, right, it's from that 60% they're going to remove their expenses, right? And then maybe when they do all of that, it comes to 30% that is now left, right? Then anybody that is promising you that is going to give you 30% rate of return, you will know it's a lie. Because if I'm going to give you 30% and I'm collecting your money and I'll take your money, I'll go and give it to the cassava farming business, right? And the cassava farming business is going to make exactly 30%. Then it doesn't make sense. I'm giving you pretty much all the money, right? So for me to give you 30%, just know that on the minimum, there will be a markup of not less than 1.5. You know, what I mean is that whatever I'm putting my money in, putting all those money I'm collecting from you in, will give me nothing less than 45% for me to be able to give you 30%, because I will have costs to carry. I will also have salary to pay myself. Salaries are a big deal. And I'm also a for-profit business. So apart from salaries, I also want to have money at the end that I'm able to add to what we call retained earnings. So when you are looking at those uh, agro funds and they are telling you we're going to give you 40%, and you're saying it makes sense, right? You are forgetting that for them to give you 40%, they probably will need, to put your money in somewhere they will get 50 or 60%. In fact, that case would be like 60%. And then if you know that 60% is unsustainable, it can happen in 1 year, but cannot happen every year, then you will know that it's just natural that 1 year will come that everything will just, blow up, right? So again, the thing is you want to always consider, even if what they are saying makes sense, it's not like 3 times the risk-free rate, so you are not yet running away. Then what is it compared to the comparable returns? Then the other part where most people don't even care about is, are they giving you financial statements that are audited? Are they giving you figures that are audited? Too many people say, oh, I went to their office, I saw their books, they showed me, they explained to me, they took me to the farm. Yes, but are you an auditor? And more importantly, when I say you're an auditor, are you even independent? So you are not yourself now. So there must be an independent auditor who is, stamping, who has verified the figures and is putting his seal, his reputation online that, yeah, this is what it really is, and without that level of disclosure that is independently verified, I wouldn't continue. I wouldn't put my money in such an investment, right? That's why some people would rather be on the board, because that's how close to auditing what's happening as possible. So if you know that, yes, this company, maybe they don't have an auditor that is going to be an external, reputable auditor that's going to, because of you now, they will incur that cost and, be giving you monthly or annual or quarterly, at least quarterly anyway, quarterly uh, quarterly reports. Even if it's going to be audited once a year, you know that you don't have figures that are cooked up for too long. So the key thing is, if this information are not giving you on a frequent basis, timely audited reports, then you'd want to not also continue. You don't want to continue because they can always paint things to look as they want, And the problem is that when things go wrong, you will always be the last to know. Why? Because they will try all what they can to bury the figures, to not make it. And since you are not seeing those figures, nobody's auditing on your behalf. Or what you know is that they paid me 3 months ago, they paid me 5 months ago, whereas the money they are paying you is probably borrowed money, or things have already gone on that over a year ago. So again, that's the audited part. Then the last layer, the uppermost layer, which is this, is now where you begin to think about how you calculate your ROI. So I'm going to tell you there are two different investments. There's the one that will tell you that I'm going to give you back your capital. So your capital is more like separate. They will give you back your capital, and then they will give you an ROI on top, right? Then there are some other investments that your capital is not giving you separately. So they will say, you know what, put 5 million naira in this, and every six months we'll give you, 1 million naira. They are never going to give you back your 10 million naira, but they will be giving you 1 million naira every six months. So the way you calculate them are different. So you don't mix up things. You don't use the wrong calculation. I'll give you an example. I'm into crypto mining, and the equipment I buy, right? So I pay maybe $1,000 for the equipment right now, and I'm maybe making, say, $100 every month, right? So that $100 every month, if you think about it, you'll be like $100 of it over $1,000. That's 10%. So you're like, oh, Michael is having a 10% ROI. That's not correct, right? Because if I put that $1,000 in, say, a 10% fixed income, 10% USD fixed income, I'm going to have that my $1,000 separate, and I'm having the $100 also separate, right? But this miner that I've bought, it's a sunk cost, So that $100 is what I'm having. There is no point in the future when I will get back the 1,000 that I've sunk in. So you want to understand that those are two different kinds of investments, and the calculation is different, right? The way you think about the calculation and you take them is different, because the ones that your capital is separate, that is, let's use that as the standard, as what you want to take as the benchmark. Then the one where your capital is not, is part of, is like it's gone, it's sunk, it's like you've bought a house and then you're just collecting rent. And well, I wouldn't say that one, because the house you can sell it. But think about something else. Maybe you bought a field that has gold, and you are making gold from it. As you are taking gold from it, the gold is reducing, and at the point there will be no more gold there. So it's not like that your money will still be there at the end of the investment cycle. So just think about that when we get to the calculation part. Then I will show you how to do the calculation. Then the other part is, this is just so that you understand that these two are separate, and you must factor them when you're calculating. Don't always mistake that all ROIs are separate from capital. Some are ROIs that your capital is gone. The returns you are getting is as if your capital is gone. So you need to know how to compare the two types. And the one we take as benchmark is one where your capital is separate, and then the return is on top of your separate guaranteed venture capital, So the other thing is, you want to know the truth as fast as things are happening. So that's why I said it's better you make sure that there's somebody auditing the reports. Now that I've talked about this story, I'm going to give us a slide anyway. Let's see how practically we apply this knowledge, right? So this is it. By the way, I would like you to also give me examples of investment opportunities you've come across, and you see how we apply this. So now this is the whole stuff. The theory of all what I've said is what we call the law of one price. Law of one price. The theory is embedded in this law of one price. What law of one price says is that the price of assets, security, investment, so I'm using all the words that we're familiar with, is same everywhere. Okay, now that sounds too general. Let's begin to look at it specifically. So what it says is that if someone says that I have a business opportunity, where let's start from something very, very easy. So where we are going to be making 20% rental income. So we are into real estate, and what we are doing is going to be giving us 20% annual rental income. Law of one price says that in that real estate business, annual rental income is same for all players. does that mean? That if you have a house in Bagada or you have a house in Antony, right? That the rental income you're going to be making from that house is going to be comparable to the rental income everybody else in that area too are making from their house. Now everybody will easily say, no, I know some houses where the rent is higher, even though the house is the same as the one beside it. Come to that, right? But see, the law of one business says that no business person should be able to say that I am making a superior gain. No business person should be able to say, so if the industry, or in this case, the sector ROI is 15%, right? If the sector ROI is 15%, and you say you are making 20%, what the law of one price says is that your 20% ROI is what we call superior gain. And it can never be this both. It can never be sustainable and scalable. Yes, there can be one landlord that has decided that he's never going to give his house at less than 20%, even if every other person is collecting 15%, right? And he will always find a tenant. Why? It's just one house. There's always going to be exceptions. But now imagine the landlord now starts building houses. He's scaling, he's having 20. This year he has 5 houses. Next year he has 20 houses. And he wants to maintain that is a 20%. He's going to hit a limit. At the point, he's just not going to, he's going to have many empty houses. Okay. And at that point, he will have to come back to reality and begin to get the normal return. This is where things get complex for some people. We all know in real life that one person can come up with a strategy that can make him do better than everybody else. You can have a store, and in your store, you're able to do things so well that your cost is so small and you are making more profit than every other person in your locality, in your territory. It's not impossible. The key thing is that you cannot at the same time scale it and make it sustainable. You cannot begin to say, oh, I have this thing and it worked fine. I'm going to have 200 of it. And then you want to keep doing the same thing. It's just not possible. It's just not possible because I don't know how well to explain it. But that's just the truth. That's why it's easier to use the house rent, because the truth is that the people that are making you to collect more than other people are collecting from their rent is maybe because they like that your particular color of house. They are like what we call the fringe customers, right? If you decide that you are always going to collect a salary of 2 million naira for something that every other companies are paying their staff at 500,000 naira, because there's only one of you, right? You might be able to bullshit your way into different companies and they pay you. Even if they sack you, you still find another person, right? But now imagine that you want to create a business out of saying you will train people on how to be collecting 2 million naira salary, for a job that every other company, all other people are being paid 500,000. You will now understand that whatever was special when it was just you cannot be special for 200 people anymore, right? You will just create people who will be frustrated. So the same thing when people come to you and they are raising money because they want to scale and they have found a strategy that gives them superior gain, right? So you find out that, yes, when it was just them running at a small level, when you are a student and you're doing a business, your cost is low, your tastes are low, you are able to transfer expenses to some other people. You could be making crazy gains. But then you have graduated, you have family to feed, you now want to scale this thing, you want to do it big. You want to say, oh, because when you are a student, you used to get 60% return on investment. Now you're telling people to give you money that, and you want to promise them 40% with the hope that you will get the say 50, say 70%, you keep 30%, you give them 40%. The thing is that the moment you scale it, your superior gain is gone. You know, whatever reality every other person was facing, you begin to face it. Staff, and that will have to be managing it when you are not there. The cost of managing those staffs, the staffs are going to be similar to the staffs that are in other places. There's nothing that is going to be superior anymore to you. You know, everybody begins to see your houses as same as, after all, your house is like this, house is like that. In fact, there are 200 of your houses are alike already. So there's nothing unique anymore. You can't be charging superior profit, right? So the moment people come to you and they raise money, and the strategies that they have a superior strategy that is giving them superior gain, just know that it cannot be sustainable and scalable at the same time. Sustainable means it cannot continue to happen that way for a very long time, and they keep scaling it. So that's what law of one price says. Law of one price says that in the end, the price that everybody's collecting, when we say price, in this case, return on investment too, because it's not just the price everything is a price anyway. So for us now as an investor, this price is returns. You know, so whatever returns everybody is getting, right? That superior return that somebody was getting before begins to tend. That's what we call it. This is like tend towards. It begins to converge. Begins to tend towards this, right? So let me give you a very clear example that is happening right now. Some of you might not know it, some might know. That's why I want to use an example that is reality. So there is something people are doing, and if you go on YouTube and you search for Naira arbitrage, and you search for Naira arbitrage, so you will see people will tell you, you see a lot of them. So they will say, oh, you know what? You can use your bank ATM to get dollar at 450 thereabout per dollar, right? So, and then you go to where you are able to get it back, you know, sell at black market rates. So you find a way to now go back there, you know, and then sell at where your $1 now fetch you 570 naira per dollar. Okay, and yes, it's happening. You know, there's nothing that is like hidden or special. Everybody can do this, and you're not breaking any law. Why? Some banks give you $100 limit per month. Some give you $300 limit per month. And there's even one that if you pay a particular amount per year, you get, I think, about $2,000 per month, right? So yes, you get this, and then if somehow you are able to find people who need dollars and you pay for them, somebody wants to pay for something online, and you charge the person at $1 to, maybe you even make it easy for the person so that the person doesn't go to black market. You say, you know what, instead of 570 that is at the black market, I'm going to do for you at 520, which means that you'll be profiting 17 naira per dollar, right? Think about it. Yes, you can do this. Even if you are doing this one of $2,000 per month, right? What will you make? You're going to make 2,000 naira times 70, you know, $2,000 times 70, and that will give us like 40. That's 140,000 naira that you will make, right? Which for some people is not a bad amount. 140,000 naira a month, naira. Now, when you are telling somebody this, you are not lying. There is no lie in what you are saying. It is the truth, right? But the moment you begin to say, I'm going to give me your money, you know, give me your money, I'm raising funds. I'm like, give me your money. I'm going to use your money for this thing I'm doing, right? And then I'm going to give you back some returns. This is a case situation where you want to scale it. And you find out that it's not going to be sustainable. Why? The banks have limited you to no more. The one that gives the most gives you no more than $2,000, right? So you find out that the things that gives you ability to exploit superior strategy, because it's like a superior strategy, found a loophole, you're exploiting it. It's not, you're not the one who created the loophole. Just what it is, right? The BN and the banks and the whole Nigerian situation has created this opportunity for a superior gain. Now, everybody knows that this is not going to be forever. So, it's not going to be forever. It's obviously not supposed to be forever. The other thing is that it cannot scale. Why? There is already a limit on the amount that you can access at the unusual, unusual rates. So this is telling you as regards when someone tells you that I can give you 3 times, the risk-free rates. Right now in Nigeria, risk-free rate is 10% Naira. Whatever is making them to generate 3 times the risk-free rate is obviously a superior strategy. Doesn't mean that it's a lie. Doesn't really have to mean that it's a lie. Like I've shown you that your normal bank card, you can actually be making free money. Not a lie. It doesn't have to be something that has to be very complex too. But the problem is that these things don't scale. The moment they start collecting other people's money, just like someone who used to trade Forex, right? And he was doing really well by himself, and he now comes to you based on his own personal reports, success track record here. And then you're like, he turned the 10,000 USD to 100,000 USD. Oh, I'm going to give him all of my savings of 50,000 USD. Then you begin to understand that what worked for 10,000 USD, might never really work when he gets all that kind of money from different people and he gets now like 10 million USD and he wants to replicate the same magic that happened. So that's why you see that most of those people, they always eventually crash. And it was not that they were lying when they told you that they turned the 1,000 USD to 100,000 or 50,000. It was the truth. But the problem is that whatever superior strategy they used then, right, no longer applies when you want to scale. The more you scale, the more reality hits you. The more you become like everybody else. The more you scale, the more that whatever was superior becomes no longer superior. It's just like when you say you found you're able to gather 5 7-foot tall people. Not a problem. 5, you can find 5. But now you say you want to find 1,000,000 7-foot tall people. Then you will understand that whatever you did to get 5 will not work to get 1,000,000 because it is not normal. Most people's normal height is between 6 feet, some plus or minus 5 inches around 6 feet, right? So anything that we call superior, but as long as what they are telling you that they are doing is something that is unique, I don't want to be mentioning some investment name, but there's one recently that when I asked them how they're going to make, so I will not mention the name, but I will tell you what they said. So look at what they said. They said they have 3 investment options, right? So they have one that is fixed income. Now this fixed income, they are giving me a guaranteed on USD. They're going to give me a guaranteed 10% annual return on USD. Now, ladies and gentlemen, let's go and check what is the risk-free USD rates. The risk-free USD rates. If you type US treasuries. US Treasury yield. These are the 3 months, 1 year. They are giving me 1 year guaranteed. So if you take the equivalent 1 year one, is this not 1%, right? This is the US, right? This is the US Treasury bill. There's no, they don't sell to some people at one yield and send to another people at another yield. It is as transparent as you can get it. Like, I mean, Nigeria, you search for it. You're anywhere in the world, you are even in the Senate, this is what you buy it at. Well, there's no special versions of it. 1%. So what are you guys giving me? You're giving me 10 times the risk-free rates. Maybe if that doesn't look spooky yet to you, let's go and look at what is the long-term US stocks return. At least we all know that stocks are risky, right? We all know that stocks are never guaranteed returns, right? So good. US long-term the historical average stock market return is 10%. Now, this 10% is always over very long years, right? So there will be some years of down, some years of above, but over a very long time, you know. Some people will say you take it over 20, 30 years, you know, that is over 30 years, you know. Good. These guys are going to give you what people are risking their money in the stock market to get over 30 years. These guys are going to give you guaranteed that same return, you know, in 1 year, always guaranteed. So I tell you, the money must definitely be a superior strategy. And that's what they told me when I asked them. They said, oh, we have some strategic things. We put our money in Euro bonds, put our money in some specific government things. They explained that what they are putting their money in is as something that is not the normal. So it's definitely a superior strategy. Now, remember what I talked about superior strategy. Superior strategy, is when I see that there's a landlord that is not smart. He's not in the US. I mean, he's not in Nigeria. He's not aware of how much his rent is. The house in his areas are renting now. I'm a caretaker or I'm into real estate. Talking with him, I'm like, this man does not know. So superior strategy is that I found like 4 or 5 of those kind of landlords, right? I am collecting, I'm telling them that, you know what, I will do a managed apartment. I'm paying you rent on your property. I'm paying you rent, guaranteed 2 million naira every year. And then what do? I even pay them up front. So every start of the year, when people are collecting, maybe I pay them 2 years, whatever. Anyway, I'm paying him without even at first, without even getting the tenant first, so that they will know that his money is guaranteed, right? Then I go and rent it out at 4 million naira. And then I'm saying, yeah, that's a superior strategy, right? It will work. But the moment I start raising money, the moment I start telling people that I want to apply the superior strategy to, instead of 5 houses, 5,000 houses, then it's not going to work. I'm not going to find landlords that are not that savvy about their investment, and then I'm going to be making a superior income. So what I'm trying to say is whatever they are doing that maybe would have worked when they were verifying the concepts, the truth is that they will never, if people are putting in money and they keep adding money and adding money, they will run out of those superior opportunities. It's just a normal thing. It's only if you want to ignore reality that you will say, you know, it is not going to happen, that the more money you give them, the more they will find those opportunities. It's not like that. It's never, that's why it's called a superior strategy. It's superior because it's not normal. The opposite of superior is normal. And normal is when you take too many of the same things, then they start, that's normal. Superior is there's just a few things that are in that category, right? So what am I saying? Whatever they are doing must definitely be superior strategy. And I've told you, no superior strategy can scale. sustainable. Just a matter of time before you will see. And that's why you notice that most of those guys, they will never show you an audited account because this, that's how you will know that what they are doing will not scale, And the faster you know, the more the whole thing will come down. Why all of you will start asking back for your money because you already see a cliff that we're going to fall off. So that's why if you want to even go ahead, if somebody is promising you something that is so superior, then you at least let them be giving you audited financials. I put my money in Seplat, right? I have my money in Caverton Helicopters. I bought their shares. Why? I know that they are generating the superior return. But why? I'm seeing their financial statements, right? And it's audited by third parties and they are posting it. So whenever things change, I can remove my money. I don't need, there's no fear. I don't have to go and be messaging the MD. MD, are you sure this thing will work? Because that's what is happening on all those other ones. You will be going on their platform and messaging the admin, and what will they tell you? They will tell you in very nice sounding ways, telling you they are doing something special that nobody else is doing. Yeah, everybody's always doing something special. If my employer asks me, what is unique about why I'm doing my job, I'm special, doing it special, even if it is the way that I evaluate what I do that is special, it's still special enough. So, but the thing is, if you are not having audited financials, audited timely returns, then setting yourself up. So now, anybody has any example of what you want us to use this on? Remember what I said, that the red flags you want to avoid is number one, somebody says you're going to get a guaranteed return, but two, that is 3 times or more risk-free return. You run. So now next is, all right, this is not they are not telling me it is guaranteed. So they are telling me, oh, you know what, we are doing real estate. It's not guaranteed, it will be up and down. We are not telling you get a guaranteed 50%, or we are promising you 50%, but that it can be a bit more, it can be a bit less, but on average 15%, right? What do you do? So that same investment stock, one of them, told me that in USD they're going to give 50% loans. Now, what did I do? I checked what's the comparable. So I went online, searched for what is the, because US dollars, right? So obviously comparable. If they say it's US real estate. So what is US real estate rental? Thank God you can see it popped up. Right. The moment I search this information, comparable returns are always easy to get because it's an industry. And then nobody is the first to do anything in an industry, right? So I go here and I search. Go different, you can pull up as many results as you want. Okay, good. So I go here and I search. What is the rental yield? So let's look for US. So they say it is let's even round it up to 3%. Right. So in US, the rental yield, the comparable return. Yes, the 3% is not guaranteed. It goes up and down, but that is the comparable return. So they didn't tell you the 15% is guaranteed. It goes up and down. Comparable return is 3%, right? So now look at it. When you look at what I said, that if someone is giving you a return that is far above the comparable return, then flags should start, red sparks should start flying. So this is this is 5 times the comparable return. So again, what does this mean? It means whatever real estate that they're investing in, not the usual one. It could be even a very extreme case of maybe the property owners are having some stress. Maybe they are under. I need to meet people now. Speaker is possible. Maybe it means that they are looking for very distressed, very distressed owners who are willing to sell at that crazy low price that will make the return, the rental yield to be that 50% high. Because you know what, if maybe the market price of the house is 50,000, right? And is that 50,000 that people are getting 3% rental yield on? And for you to now be able to get 15%, it means you probably will have to buy the house for like 15,000 USD. Now it's not uncommon. You can find one house in a whole town, in a whole municipal. You can find one or two houses that will be like that. Either you put the gun to the head of the seller and they eventually sold to you, or you always go to court proceedings and you see people who are being sued and who are no longer having money to pay lawyers, and you go and meet them and you strike a deal. I'm going to buy that your house. I'll give you cash now. I'm not going to do any due diligence. Yes, you can have some superior strategy that makes you to get that very, very discounted houses, right? But man, you can't kill sustainably. And so when somebody is raising money again and again, repeatedly, and they never come back and tell you that, oh, sorry, we have hit the limit. We are no longer raising money for this opportunity because we have run out of opportunities. ARM Properties in 2019, yeah, I think it was 2018, did an extraordinary general meeting, where they told us, the investors, and said they want to change the investment charter because they are having trouble finding real estate properties, because they have this plan that they're going to put 40% in this type of property, 20% in fixed income. And they had to tell us and say that we have run out of this kind of opportunities because we now are so big than what we were 3 years ago. And we are not able to tell people to stop putting money in the fund. So now the only thing we can say is we need to change the charter and explain that, sorry, we can no longer do 40% in these properties. We want to increase the percentage in fixed income to 40 and reduce this one to as low as 20. That's what transparency forces, because they do audited reports every year. So they are forced to be transparent. They are forced to be able to open up and say, oh, our superior strategy is no longer working because we are now this big. But you know what? Those other ones, they are not giving you any audited reports. So what happens is that they can take out of the money and put it in crypto. As far as you are concerned, as long as you are getting the returns, you don't care. They are already changing the charter. They don't own any. They have not become any. They have not become this thing we call the fiduciary right. They don't have any. They don't feel any responsibility to always tell you what strategy they are using, right? So as they are flipping the strategy, remember I told you ARM Properties, all their money is not into properties, and their name is ARM Properties, and in the charter they explain it that way. So when they tell you they are doing real estate, it's very rare that all the money is also into real estate, right? So, but what ARM Properties and most of all these open funds do is they document their investment processes. They let you know, like mutual funds, we put X percentage, a range of this percent will be into this type of properties, this type of asset category, another range of this will be into that other type. And they let you know ahead that some money will be in fixed income, some will be in cash, and then the rest will be in the properties, real estate properties themselves. So these guys, obviously, all your money are not there, but then because you don't know what percentage is even inside the real estate they're talking about, you don't know, maybe more than 50% is probably into crypto. So what I'm just saying is that this is how I apply it. And from what I'm telling you, you see that these are red flags already. I'm not going to put my money there. There's no temptation. I'm not going to say I want to load it. So that I'm doing money personally, I don't know if it's a trustworthy person, I want to read the story. There's no story to read because there is, first of all, the principle that always holds true. You cannot scale sustainably a superior strategy. No matter who you are, right? You cannot do it. It's not possible. Okay. So now the third one is I find something that the return is comparable, not so crazy high than what every other person is giving, and they give me audited financial reports, then I'm going to be like, all right, how do I calculate my money? How do I compare between something that is, I'm putting 1,000 USD, and they are going to keep my 1,000 USD taxed, and they're going to be giving me $100 every month, versus the one where I'm going to put 1,000 USD, and the only thing I'll be getting is $150 per month, right? Like I told you, you can't just jump straight into this and say, oh, this one is better. This is not yet better because your capital is not intact, right? So you want to be able to compare them. You want to be able to say, okay, between these two, which is better, which is giving me a bigger return, right? Might have to stop here because of time, but there is a formula we use, right? A call it IRR, internal rate of return. You need to use internal rate of return, and it's very easy to calculate. It's just to say for the periods of the duration of the investment, right? So let's say the month. So month 1, month 2, month 3. So let's say all of them, they will give you money for the next 4 years. 4 years is a 48 months. Okay? And they will terminate in 48 months. Okay. Everything can always have an approximate termination period. So cash flow from opportunity A, cash flow A. A is this one of cash flow B. Cash flow A, right? Let's say there's also month 0. So in month 0, or for both of them, you are first of all putting down 1,000 USD. Okay. So not everybody understands bracket. And then cash flow A is going to be giving you $100 every month, right? And then on the last month, you also withdraw back your 1,000, right? So you want to compare them maybe across 4 years and say, okay, in the next 4 years, which one's return is better? If you want to just make sure everything is a 4-year consideration for you. Then this other one is going to be giving you $150 every month for the next 4 years, but you are not going to get 1,100. I mean, another 1,000. That your original money is gone. Can somebody tell me among the audience, which one? Can somebody tell me which one you think is better? Which one, if you are the one doing this, which one better investment? Just guess. Are you going to do investment A or are you going to do investment B?
Investment B, I think.
Investment B. Is that what you said?
Yes.
B. Someone is picking B. Anybody picking a different answer? Okay, let's quickly just see the answer mathematically. So that's where what I mean by here, that you must always do your calculation to understand that your ROI and your capital, for some, capital is still separate and intact, and ROI you're getting. Some other ones, your capital is like sunk, gone, and then it's that return that is the only thing you're getting. So, all right, so let's do it together. So if I do the formula IRR, that's the formula IRR. that's just it is very straightforward. Some people can argue it's not accurate, it's not blah blah. The accuracy they're talking about is just very infinitesimal kind of argument, so it's not fine for our own comparison. So if I do this one says, yeah, I'm getting 10%. Now let's do. Now option B is actually giving 50%. Option B is by far better, right? But then most people, when you are presented with this, we stop because you'll be like, oh, my 1,000 is gone. No, I'm not. These other people say my 1,000 is still there, we will be able to collect it anytime. So most people find it difficult to do a quick comparison, right? And it's because it's actually difficult to do, right? What if the figures are really close? What if it is a 120 USD you are getting, not 300? So how again will you really know, right? So until you do it mathematically, you never can tell. So that's why it's best you also know how to do some of these mathematical calculations, so you can be able to now say, okay, I have two investment opportunities that they have met all the conditions. I get information timely that is audited, and I get to know the truth as fast as possible. It's not like they are giving me 4 years ago report, 3 years ago report. Getting quarterly, half a yearly, at worst annually reports, right? Annually is not very good anyway. So 6 months or quarterly, I would say you can live with. And then how then do you decide which one to do? So now that we have covered all of this, I'm going to end here. Any questions? Or do you have an investment opportunity that you want us to try this on? There's somebody has brought to your attention and want me to evaluate it, and together we should use this, seeing whether it makes sense or not, whether it should run or stay. Okay, yes, I see someone's hand up. So premium, yes, carry on.
Yeah. Hello, good afternoon.
Yes, good afternoon.
Okay, thank you for your lecture. It's so enlightening and an eye-opener. I sincerely appreciate your effort.
Thank you.
Yeah, personally, and for a couple of friends of mine, we've fallen victim of all these scam or ponzi, as is generally known. And for us, I would say largely because we do not really work with these fundamentals. Because if we're to be for the knowledge sake, yeah, fine. But somehow we disregarded some of these things. And this step from the fact that, okay, I don't like where you wrote on that, what's it called? Where you talked about truth, yes, truth, something about truth and all that. And because I think we base it largely on trust. And briefly, I'll just share the summary of what transpired because we stay outside the country, and we have colleagues of ours who are into business. We all work as a medical practitioner. And we, over time, you tend to gain trust of your colleagues, and even
Your audio has gone off. Oh, sure he knows his audio has gone off. If you can hear me, premium, your audio has gone off. Type it in the chat box so he knows.
Hello.
Okay. Yes, now I hear you.
Oh, okay, sir. Sorry about that.
Some seconds.
Oh, okay. Yeah, sorry. All right. So we trusted so much, and we were scammed so soon. We knew this person as being a colleague, and of course that's characteristics of maybe being a scammer or someone tending towards Ponzi and all those things. We didn't suspect it. All right. So it was when the whole thing happened, it now became like, wow. So something like this could happen. Anyway, the long and short of it is that we put our money, because she came in with that tone of being someone into businesses, into investments and all that. And we tend to believe, because being all over the place, you know.
Yeah, carry on. Sorry, I don't know where the
Yes.
background is.
Okay, sir. So being that she was someone that was all over the place, where we in the country we are and all that, and so we tend to believe, okay, people speak good of her and all those things. Then when we started the investment, after the first, I think the second return, she began to give excuses, and might be, oh, sorry, there was a delay. The shipment that was supposed to come from this particular country didn't come, because the investments were into commodities and goods like ginger, honey, and there was one, she said it was gold and all that. So, but we never had that out of doubt or suspicion to, like, okay, this person was actually planning to scam us. Eventually, she left the country, and it now became a real problem, asking her where's the money and all that. Then she began to give different stories. She wasn't the one to the business, it was someone, and the person took away the money and all those things. And the money we're talking of is not, maybe, yeah, it's small, but of course it's something we need. This is over, if collectively, at least for the few ones that I know and we've been interacting over time, this over, in Nigerian money, is over 150 million naira.
That's a lot of money.
Yeah, so yeah, so I'll tell you what we've done. We've reached out to the authority that's in Nigeria, which was where the business was situated, because she presented us with some of those documents, like those company documents, their registration certificate and all of that, with CSC and all that. So maybe that's to link credibility to the genuineness of that business or something. She did all that. So we've even contacted the EFCC and all the stuff. The thing has begun anyway, but I don't know whether there's any way. I've really gained a lot from your lecture, and thank God I know this kind of stuff cannot repeat itself, definitely. Whether you think there's any advice you can give, or any guidance on how to get the money. We are many. I don't mind if we don't want to speak or talk here. If it's outside this, fantastic. I can also hook up.
So, from what I know about three things, actually, truth is, before this gets to the stage where it's now so obvious to you that the person has played a fast, they usually know way longer. And what they do is, it's almost like, look at Alice Madueke, the battled former petroleum minister. Again, maybe some of what are attached to her are lies or not. I don't know which is lie or true. But one thing all of us can know is that she took a special care in ensuring that it's very difficult for her to be gotten, right? Because she had a lot of pre-warnings. Whoever those who are going after, maybe she had a long time it wasn't something sudden. So it's almost like that stage 2 here, in this case, where the person knows that all of this is going to happen, so some of them will buy another citizenship somewhere, go different places. But if you look at what people do who are trying to run away from the law, you'll find out that that's usually what they do. So sometimes you want to maybe engage people. That's their own area. That's their own specialty. People who give, for instance, I know in the crypto space, right? There are the truth is just that I don't want to say in the crypto space, but let me say in the tech space, there are people who their work is to find people who in quotes, don't want to be found. All
Okay.
they need is to trace your technical, your IT print. Everybody connects to internet. That's just it, you know. And Nigerians,
Okay.
when we are thinking of how to escape the law, we are not thinking of how to get ourselves out of internet. We are thinking of how to make EFCC not grab us, and which are the people you are sending against the person. How to ensure if Interpol want to grab someone, they will go through the local. Interpol is not going to just, you know, bypass Nigerian this thing. So you find out that most of them, if they have that fund, they spend it as well on how to ensure that, you know, they have people within the systems in Nigeria here to, in quote, shield them, to make it very difficult, maybe pre-warn them, to give them information ahead, make it very, very difficult for you to use the real, you know, legal and security infrastructure,
Conventional.
conventional ways. So sometimes you might just need to look for people. That's their own job, is to find people who don't want to be found. People, they will trace the person, and it's just that now finding is one thing, accosting is another. So again, you might now want to. There's a way that the offense can be that another country's jurisdiction can want to even arrest. Not even if they're arresting, it's something that whatever maximum charge that the person will get might not be more than 1 month detention. But the fact that they arrest and then the person is now in a particular custody where our own security officers will not be able to play hanky-panky anymore. You know, maybe, you know, if there's in all of the offenses that has happened, there's one that maybe touches around. I know if you scam a US citizen, then somehow you can use US legal, US security forces to can register it as a crime that the police and uh, security people there can be the one to even want to make the arrest. So I would just say you might need to look for unconventional ways to get the person. The first thing is even to find the person. Then maybe the next thing will now be how to make the person face judgment or make reparations.
Okay, thank you so much. Interestingly, we know where the person is as per the country she is. So, but we've been seeing some form of lethargy from the authority and all that. So that's why, like what you suggested, I don't mind. It's something, if I speak with my colleagues, we'll be able to, you know, follow through.
Sorry about the old. That's the person wouldn't have spent too much of the money trying to hide, because that's the other problem. Like the
Yeah.
person started buying sections. So Ijeoma, I see your hand up. And also if it's a question or a contribution you have. Hello, Ijeoma, your hand is up.
Okay. Good afternoon.
Yes, good afternoon.
Okay, it's actually a question because you're really doing a good job because I just stumbled upon this through someone else's link. So I was really happy I listened to this. The question I want to ask is in real estate because I just got an information about a real estate, and of everything they said, the only thing that got to me was the buy and sell. They've been into real estate for like 10 years now. So and the return on investments that's the ROI for 1 year is 40%. I was like, how possible is this? Despite the amount, although they actually fractioned it into 3 quarters of the year, like first 3 months, first 6 months, and if you want the whole year. I think they said the first 6 months, that's if you want to invest for 6 months, that I think is 17.5, but the entire year is 40%. So I'm like, even with what you've explained so far, it seems bogus, except if they have, like you said, a superior strategy.
And in
Thank you.
addition, is there an audited report?
I have not requested anyway. But from what you said, I have to request.
That at this stage now, you even want to know if what they are telling you is true. When
Yes,
I say true,
exactly.
true, not true that are they paying people that amount, but is it true that the business is generating that amount?
Amount, because what has been going through my mind is how then do they make it?
Same thing too
Although
is a
they
question
have
of
different,
that how
packages.
the truth
How?
is 40% in Nigerian real estate is obviously a superior.
Okay.
It's obviously a superior return.
Okay.
So the next questions are number one. First of all, is it true? Is it that whatever they are doing is true? Like because superior strategy could even be that your money is not even in real estate, like that they are able to get money and even a Ponzi scheme that is returning very well is a superior strategy. It's just that the more people put in money and the more people are asking money, and then somehow maybe not enough people put in money, and it crumbles. It doesn't scale, and it's not sustainable. So,
Okay.
but the key thing is that first of all, you even want to be sure that what they are telling you is the truth. It's not like there's no houses. You want to see that
Yes.
there's a balance sheet, there's an income statement that reflects all of this, and if possibly also that's why audited is a real thing where someone else has audited it. So if on seeing the audited financials, it's reasonable.
Okay.
Like from it, you can see for certain that yes, they make more than 40% for them to give you 40% because they can't give you all what they make. So nobody will take
Yes,
your money
exactly.
and give you everything they make. Then they are not into business. They should rather say they're into charity, or they are sweating for you and So obviously for them to give 40% means they probably are making 70%. Now the truth is I know one company that I bought from that they too have something like this plan. But their business, I saw it because I bought land from them. They buy land really cheap
Okay.
and they are able to
Okay.
sell very well because they structure it as estate and they sell to those of us that we are afraid of money there and people outside the country and,
Exactly.
and then they sell it at like times 20 markup. Something they buy at like 300,000 per plot. They are collecting like 5 million, 8 million per plot, on it. So I see that part, but the truth is those kind of lands are not in infinite supply. The kind of lands that you can buy that cheap and sell that high are usually in very select places. They are mostly in these Lekki Ekpe axis because people they can always tell you that airport will come there, Dangote is there, that is there, but they are obviously not in a maybe Songo area because there's nobody that is looking to buy stories and we will not buy directly from someone when he can buy at 500,000 naira and he wants to buy from me at 5 million. And everybody will call him stupid, but then everybody is already buying that type already in Lekki Ekpe, so nobody will call anyone stupid for that. It's like everybody is doing that. And everybody is afraid of their own kind of money-led stories they hear. They are crazy. So, but one thing I know also too, like I said, it can't scale. So you don't know if you are not involved in the financials, if they don't do disclosure to you, you will not know when the scale has gone off. You will not know when they don't have those kind of properties anymore. And if they still keep selling, it's just like how they tell us that some of these real estate companies that they will sell to you, they will give you paper allocation, and you find out in the end that there are only 500 lands and they've allocated on paper to 4,000 people, and then there's problem that is going to happen in the future. So there are all kinds of things that are happening that even in genuine businesses, right? When I say genuine, like the underlying business is not illegal, it's not a scam. Somehow because there is no disclosure, people take things to extreme and it begins to be like a scam because why will you have 500 plots of land and you sell to 5,000 people and you're giving all of them, when you've given all of them a letter of allocation, then the idea is that not everybody will pay for development fee. That's why some of them are so very bold in charging very high development fee. because they don't want you to pay. So because the more everybody pays for development fee, and then it becomes obvious that the land is not up to enough. So there are all kinds of crazy things happening. But the truth is, you want to know, you want to have access to the audited information, know fast. And if you can't know, that's not the only way to make money. There are some things that there's some problem that is better left alone. There's no only one way to make money. So if one thing can make money, and because you don't have all the details, you don't want to let it go, I think that's not a sound thing. If I don't have all the information, I don't care. I might be wrong. I'm okay to be wrong based on the fact that I don't have all the details, than to be wanting to be right at all costs and then be at the short end. So I would say if you really want to go into it, make sure that they give you verified, audited financials, and then you want to see the truth as fast as it's happening. You want to be sure that they've not run out of whatever superior strategy they are deploying, and then you're now being sold empty bags. So that's my own opinion.
All right. Thank you very much.
So I think if there are no other questions or contributions, I need to just bring it all to a close now. But thank you for joining and staying this long, and I know the beginning was a bit boring because, again, the truth is I wanted to show us the theory side of it first. I think someone's on this. Check. Yes, Mr. Temitai, I see you on.
Good afternoon, everyone.
Good afternoon.
I could see that you're making a lot of reference to audited accounts. The same way we have scammers amongst these people, investment people, we also have a lot of auditors that are also not credible. You understand that you have a lot of auditors here, particularly in Nigeria, the country, that is just what you want, is what the company wants to see. That's what they do for them. So I just wanted to mention that even in trying to review audited accounts, we should also look deeper and ask intelligent questions beyond the fact that it's audited. You understand what I'm trying to say? So when you take the likes of maybe the big four auditing firms, you take out maybe some other second level top auditing firms in Nigeria, you have a lot of anchor firms that are just there to eat. So you don't just want to say, okay, they've given me audited accounts, and they are audited. So you need to look deeper and be able to ask intelligent questions, and if they are not able to provide convincing answers, you'll be able to determine whether exactly. So that's what I wanted to mention. Thank you.
Thank you for raising that. Interestingly, this thing you said happened recently. So someone within my network reached out to me to help him evaluate an opportunity. And so I said, okay, I asked them for the audited financials, and they sent, And then after they sent it, the signer told him, I said, ask for the TCC. So when they sent the TCC, TCC stands for like the tax clearance certificate, is that one. It was different too. What was on the tax was really different from what was in the financials. So because the tax, it's just that I can't show you my own tax clearance certificate for a company. They will write what your profit is for the last 3 years. So that way you can always see whether you might not see all the balance sheets, but the truth is, if someone's audited is already different from what's in the tax, then you know that they cooked that audited account for you. So I agree, it's true. It's sad, but it's also true that also audited financials can be exactly what the owners and the person should put there. So maybe as a second level, just also ask for the tax clearance certificate so that you see what they filed to government. Yes, some people reduce it in the tax, but at least if one has one where both the audited and the tax clearance certificate one tallies and is trying to tell you this opportunity is profitable, then you know that then it's true. It's more legit than the one where in the audited financials they hyped up all the revenue and profit figures, and the tax they under declared drastically. and you know that, okay, there's still a whole lot of other questions if you want to proceed. So thank you very much. It's true. Thank you for raising that and bringing that up. So I'm going to end this session right now because I need to also prepare for another session that starts at 4 p.m. So thank you to everyone and have a very wonderful week ahead. I hope that we all make better investment decisions. No one is above mistakes, but the truth is, the more we know, the more we can guard against mistakes. The more we know, the better the decisions we make, and that's what we want to encourage. That's what we want to empower every one of ourselves to be able to do, to be able to look at an opportunity by yourself and be able to identify the red flags really quick. And more importantly, because you are learning in the community, you are not doubting yourself, because you know that these things are real. So you know that if this red flag is there and you say you're not doing because of the red flag, you're not second guessing yourself. You know that there are many other people who are making the same kind of decisions. They know that this road, the highway, cars are going real fast. I'm not crossing, I'm not crossing. Someone else can go and cross it. If he gets to the other side, that's his luck, but I'm not taking the risk. So that's what we are trying to ensure that every one of us also is able to do by themselves without you now getting confused. Because most times when you're at the heat of the decision, and that's when you are now asking people to help you to ascertain whether what you want to do is right or wrong. Sometimes it's too late at that point because you should have gotten what we used to evaluate long before the opportunity is there, and then there's some kind of pressure from the other person. You are asking every question they are giving you. So it's looking as if both of you have taken actions, and you now don't want to suddenly make it go to waste. And that's where the trap begins to get bigger because, it's like they have shown you everything you have asked. They are always willing to go an extra mile to give you answers. So it's as if all of you want to make that thing look legit. Whereas maybe the promised return was already 4 times risk-free rate, which if I had already looked at that as a red flag and never even bothered to continue, you wouldn't be in a situation where it would look as if you are disappointing them by no longer putting money there after. So, but thank you very, very much. I need to move and have a very wonderful Sunday ahead. Bye. Bye to everyone.